Hello and welcome to my series of fireside chats with senior executives from corporations that have over the years engaged in corporate venturing. My guest today is Jean-Marc Frangos, who spent 19 years with British Telecom and helped them in the early days to set up their corporate venture fund before expanding their digital innovation presence and leading their open innovation function. Our focus today for the conversation, though, will be the creation, the setup, and his experience in leading the CVC, the Corporate Venture Capital Vehicle, BT Ventures, with a parent being the historically British telco provider. Jean-Marc, thank you very much for making time and welcome.
Thank you, Claudia. Really pleased to be with you on this series, and I'm looking forward to sharing the experience. And I'm sure that a lot of people are interested in setting up corporate venturing now. So I hope the past experience of people like me will be helpful to them.
Absolutely. So, to set the scene, tell us a bit about BT Ventures and when you started with them, just to give us a bit of a sense of what you found when you started.
Exactly. So perhaps a little bit of history would help because my personal history and the history of the company actually led to the creation of this corporate venture fund. The history is that in the BT was one of the earliest privatized company in European telecommunications. It was privatized in 1982, which is about 10 years before the market started liberalizing in the rest of continental Europe. So BT got kind of a 10 years head start in dealing with competition in the UK and starting to expand, because as competition was growing in the UK, the only way to keep your market share overall was to expand overseas, right? So BT had this kind of international expansion in the late 80s and early 90s, which took a little bit longer for the rest of the European telcos to take place. So what happened when I, in that phase, I was recruited by BT as an engineer. I was a real-time software engineer coming out of the, purely the French technical education system. And it took me a while during the late 90s. I started working for them in the 90s. It dates me a little bit. And it took me a while to climb the ranks and get from this position of an engineer to become progressively in charge of more and more things, and particularly land on that job, which was the corporate development job for Europe. And in that function, I participated in creating joint ventures. Joint ventures are very different than corporate venture capital, believe me. They're really a different beast. But what happened to me during that time is I got involved more and more with the board at BT. And, the history of the company is we created 8 joint ventures in continental Europe. I was involved in most of these cases for the creation of the joint ventures. And when that was done, and we're talking 98, 99, at the end of that phase, we were looking at each other and said, so what do we sell now to these markets? Because the markets had liberalized at that point in Europe, and we could start selling more than just voice lines and calls. We could start doing internet and data services. Sure. But we were really short on innovation at that point. The portfolio was really thin. And that's what brought us collectively at BT to consider investing more in innovation. And of course, BT had a very large, well, not very large, but large R&D function, as you can imagine, being the incumbent telco and having been a part of the government for so long. The research function BT was very, very strong. Still is, by the way. And I started with this function, getting the corporate venture fund as a part of our R&D effort.
Right. So now, what was ultimately then, when you kicked it off, why did BT start to explore CVC? Because you indicated you needed to do more innovation, you were short on innovation. There could have been many ways that you could have developed. So why explore CVC?
Yeah, exactly. And that was a question that if I look back and ask myself why we did this, I have a hard time finding a really good reason for doing it as a CVC. But let me give you a little bit more background on that. Now we're talking about 1999. And 1999, you remember, was kind of the peak of the first internet bubble.
Yep.
And there was a significant momentum around investing in startups. I mean, everything that you could touch in Silicon Valley would turn into gold. It was fairly obvious. And there was this question of, how do we do how do we optimize our innovation play? So, if I'm completely honest with you, my personal ambition in suggesting a corporate venture, because I was the one who suggested it, was to be able to do some qualified technology shopping, if I call it like this, to be able to get access to these startups that were popping up like there was no tomorrow in Silicon Valley, and we didn't really have access to them in the UK. The UK had its own startup scene, but it was much smaller. So I also had, if I'm completely honest with you, a bit of a personal ambition because I had been doing corp dev in Europe and it was nice. But the real game, of course, as you can imagine, in '99, it looked like being a VC in Silicon Valley. So I had that in my mind as a sort of personal development ambition, if I'm completely honest. Now, if I look at the board and how I convinced them, because it took quite a bit of time, it actually took 18 months for me to convince the board. They wanted to boost innovation. We'll come back to that in a minute. And the other thing is they thought, my God, we might strike gold there if we do a corporate venture fund. An example, and that was actually one little story that got us to do it because I told you 18 months to do it, but triggering it was actually hard. Um, because BT as a company is also quite a conservative company, as you can
Sure.
imagine, a classic telecommunications company. It doesn't get into ventures like that so easily. So you have to trigger it. And the trigger story was that one of our competitors, a small competitor called Carphone Warehouse at the time, they were one of the original distributors of mobile phones when the mobile phones, you can tell from the name, it was a car phone at the time. They got into a corporate venture fund before us in Silicon Valley, and it was a sizable one. And they immediately found a couple of investments that looked like striking gold. So that was the example, kind of the fear of missing out type of thing that got us into that game, and that accelerated and triggered the whole movement. So that's how it all started.
Okay. And so now tell us a little bit about the CVC model that you picked for BT at the time, being very well aware of the historical context. This was kind of the heydays of the first .com wave, if you like. We were going headfirst into the bubble bursting very clearly. So what kind of model did you choose? Being, I think it's fair to say at the time, BT being a reasonable newcomer to not just Silicon Valley, but to the play in tech, having until then done mainly internal R&D.
Correct. No, exactly. And that was the first question that I had on my list of things to answer. Once they gave me that charter to go ahead and invest, I mean, I started looking at. I mean, the natural first thing that I looked at was how do I get one really good guy out there that's already a VC? Can I recruit one of the top guys out there? And we looked at that. And to be honest with you, the result of looking at in being able to recruit one of the top guys locally was a no-go. It was impossible because way too expensive, completely out of our remuneration league. I would say from if you look at the remuneration of VCs and what they expect, even when they move to the corporate side of things, carried interest by itself is completely out of the league of what we normally remunerate people with. So that was a no-go. And I could also have tried some younger, not as established VC guys, but then you get into a sort of, you're not so sure about their credentials, you're not so sure about how good they are at
Sure.
picking the right investment. And there was another challenge, which was we wanted this to have a strategic fit with what we were doing. I mean, we were a telco, we were a service company. We had a lot of things at stake with third generation licenses and mobility. We wanted people to be well in tune with our strategic agenda. And that was really hard when you recruit a local person. So we fairly rapidly gave up on that idea and merged towards a model which was, okay, then we're going to be part of a fund, or we're going to partner with someone. If we can't recruit someone locally, we're going to partner with someone. And we took two partnerships, I would say, passive limited partnerships. One with Sequoia Capital, we came into Sequoia 10. Another one with Vivendi at the time was a very active investor with Viventures. And Viventures was more for Europe. Vivendi was more, the Sequoia was more for the US. So we had these two, we created first, these two first stepping stones into getting into the world, the LP world. But I was not as satisfied with that because it was a passive position. So I wanted to be an active player and have kind of my own fund. So we found a well-established VC, Hambrick and Quist, that had just started a new VC unit called Granite Ventures. It was the early stage fund of Hambrick and Quist, which was an established player. And these guys had already created single LP funds where only a single corporate comes into the fund to basically to be the operator of the fund and to fund it, to provide the cash with it. That was with Texas Instruments at the time and with Adobe. So they had a hardware and they had a software player as single LP funds.
Right.
And we became the third one, BT, as a single LP telco, part of their model.
Okay. So just to recap, so with Sequoia and Vivendi, you were one LP in their existing funds. So this was a pure fund avenue route. And then with Granite, it was a single LP vehicle that they kind of managed or ran on your behalf.
So we would make those decisions. The investment decisions were made collegially with Granite Ventures. I mean, it was a single LP fund, so it was our money, but so we had a right to say whether we wanted to make that investment or not. They brought the deal flow, which was really useful, I must tell you, because getting into Silicon Valley in '99 when it's super heated, it was very difficult. So we actually started the fund in 2000, but it was kind of still very, very heated. So they brought the deal flow. We made the investment decisions collegially. It was entirely our money, our single LP money, but the Granite Venture Fund could co-invest if they wanted with us. So if they decided that we basically were a glorified, mechanism for doing good diligence for them, right? So they knew if we were going to put our money onto an investment in a technology company that was useful for the telco world, they might well co-invest. And they did the same separately with Texas Instruments, and they did the same separately with Adobe. So it was a smart move for them. And it was a bit of a win-win. So I learned a lot. I learned kind of the ropes of becoming a VC, having, term sheets on my table and making loads of decisions, and looking at cap tables and looking at teams. So it was a real good learning experience from a corporate venturing perspective.
Yeah.
And it helped me build the network because you don't get into Silicon Valley and expect to be completely connected in a matter of weeks. I mean, it takes years, actually, at least months. So right. It was a bit of a win-win for us.
And just so we're clear, at that point, you had moved physically to Silicon Valley. So, and did you at that point also build a team around you, or how were you structured?
Correct. I moved to Silicon Valley actually during 2000, and I arrived with one second in command guy who assisted me with everything about the fund. And of course, the Granite guys were very useful in helping run the investment cycle. And then progressively over the years, I added more people. So I added a sort of second analyst person that came from the UK. And then progressively over the years, I started adding a couple more functions. I also, as the function evolved beyond just a corporate venturing function, and we might want to talk about that at some point, I also recruited people to come on rotation from the main business units that were my internal customers.
Sure.
So,
Yeah, fantastic. So now back to the actual, I mean, at that point, you're investors. So you were minority investors in those startups. So you held minority equity stakes. Let me ask you, does this make sense for what I would consider a service company that British Telecom was? And still is.
yeah, well, exactly, and that's the $1 million question. Does it all make sense? I mean, do you have the right purpose for it? And I told you about the purpose right at the beginning, but if I look at it with a bit of an X-ray and the hindsight and the benefit of time, I'd say none of our purpose was rock solid at the time. I mean, it was boost innovation is very vague, right? I mean, and many even today, many CVCs, when I discuss with their original teams, why did you do it? Oh, we wanted to boost innovation. We wanted to learn from the startups. We wanted to become agile. We wanted to find the next Google or the next strike gold. None of these things are very robust from if you look
Tangible.
at the purpose. So it started being kind of built a little bit on a sand base of purpose, if I'm completely honest with you. And it became very apparent over the first 3-4 years that I had other little problems with the model. One was the fact that I was fighting with an arm tied behind my back because I needed I needed to get the governance from the company, in particular, 2 signatures every time I would make an investment. I needed the CFO signature because he wanted to verify that the investment was valid from a financial perspective, but I also needed the signature of one of the divisional leaders, one of the, we call them CEOs at BT, but one of the business units heads, that he would actually make use somehow of that technology. So I needed a two-sided governance. That, of course, slowed me down to an extent that it was very difficult for me to be competitive in that market. In Silicon Valley, term sheets come and go in a matter of days, and it always took me at least 2 or 3 weeks to get those 2 signatures, and it often involved me having to fly to the UK and be able to pitch the thing in person, which in today's virtual days it looks extreme, but that was absolutely the case. The other problem with being a service company and investing in technology is you find yourself locked in certain technologies. I mean, it happened to me a couple of times that we made an investment and then the next generation of that technology would come up and I would be stuck with the startup that I invested in, and I had fiduciary responsibilities and I was a bit conflicted because to BT I would turn around and say, hey, there's a new technology there. And then to my, as a board member of a startup that I invested in, I was kind of a little bit stuck in it. If you think of service companies, they have to be agile around technology. It's more a matter of surfing on the right one, integrating the right one, and having the platform to do that integration quickly, more than to wed yourself with a particular technology. So I suffered from that a bit from a service perspective. And I summarized it with the CEO by saying, hey, we're a digital supermarket as a telecommunications company. Why would we invest in all the products that are on our shelves? We need to make our shelves beautiful. We need to have a way to attract customers, not necessarily invest in the products themselves and the technology of the products themselves. So it became clear only after a couple of years of practicing that sport of corporate venture capital to me.
But the experience with, again, the benefit of hindsight was clearly valuable. So the minority equity stake, as you put it, was for a kind of digital supermarket, not necessary. Ultimately, if anything, it hindered you in what you were trying to do rather than giving you the advantage. Is this a fair comment?
It is a fair comment, and in fact, when after a first cycle of 10 years, which is a typical fund cycle, I decided not to renew, and I decided to move to a more agile, open innovation model where I would do deals that were more licensing deals or go-to-market deals, not necessarily linking equity into it. And sometimes I would have warrants associated with them, which had a little bit of an equity catch-up on it. But in the main, I would say for me it was a bit of a hindrance to have to deal with the equity side of things and the heavy governance around it. When I became more agile, it became actually more successful, and also it unleashed a number of other benefits of learning the ropes and being connected with Silicon Valley and the startups, which were the benefits that were surrounding the entire ecosystem, not just the startups, but also the Facebooks and the Googles and the Amazons of this world. So I became much more involved with the wider ecosystem when I had my hands free from doing all that governance.
Yeah. So that's a valuable lesson. And so in closing, and we are planning to do a part 2 where we will hear about your experience in crafting the open innovation structure. If you would give advice to any executive or any corporate that is exploring right now with let's call it the corporate venturing model. So one point that I heard earlier on was be very clear about your mandate. Don't make it just a fuzzy purpose. Any other advice you would like those executives to hear before they take the plunge?
Yes, absolutely. So you're completely right. I mean, the number one thing I advise newcomers onto that game is absolutely drill down on the purpose and don't satisfy yourself with fuzzy words like boost innovation, learn, and become like a startup. That doesn't cut it. But to get to the details of what you really have to nail, I think there's 2 or 3 things you really have to nail. Number one is your decision-making governance process. How much autonomy do you have in making those decisions? Do you have to go back to the headquarters? And how long does that take? And what are the criteria there for investment? And how are they aligned with the strategy of the company, or completely misaligned because it's purely financial? And that ambivalence is always difficult to manage. Number 2 is the downstreaming process. Once you've made an investment in a corporate context, it's very often because you want to leverage the technology inside the company somehow. So that was my second signature, remember? Now, having the signature of one guy at the top of a division is not enough. What you need to have is a mechanism whereby you can take these technologies and start embedding them in the plans and in the go-to-market plans of the company. And that takes a lot more than a single signature. It's quite a bit of work. And I ended up building an entire downstreaming team of more than 50 people back at the headquarters in order to do that, because by far that was the hardest thing to do. And the final thing I would recommend is look at measures. How are you going to measure those investments? Is it going to be purely financial? If it's strategic, what are the measures? If it's about go-to-market, if it's about generating new revenues, what are those revenues? And how much are these measures hard versus soft? Again, these are things that I've had time to develop during my time as a corporate VC and after. So very happy to talk more about that.
Very useful. So let me say thank you very much. Thank you, Jean-Marc. Jean-Marc is now also a fellow at INSEAD at our campus in San Francisco. So I'm glad you're part of the family now, and we will certainly draw on you for future conversations. Very much appreciated. Thank you.
Thank you, Claudia. Bye-bye.